Hello and welcome to Fidelity Connects. I'm Glenn Davidson. It's been a mixed picture for Treasury yields this week amidst ongoing volatility. Despite the recent lows, U.S. yields are still above the 5-year average, making bonds an attractive investment to many. Which factors are driving the appeal of fixed income investments? And why might the Fidelity team be the right choice for you and your clients? Joining me now for his fresh perspectives on the bond market, including his take on the Fed's latest interest rate decision, is Fidelity Portfolio Manager, Celso Muñoz. Celso co-manages several funds, including Fidelity Multi-Sector Bond Fund and the Fidelity Tactical Credit Fund. Celso, welcome.
Thank you, Glenn.
Wonderful to have you on your very first Fidelity Connects webcast. It's about time.
All right, it's great to be with you.
You are someone who's been with Fidelity since 2005, and yet you're a new name for our viewers today. And so I'd love you to give a bit of your background, because you've been with the firm for quite a while and you've been on the fixed income team for a long time. And so let's learn more about you.
Yeah, happy to. So like you mentioned, I joined Fidelity in 2005. So it's been 20 years now. But when I first joined Fidelity, I actually joined on the equity side. I joined as an equity analyst covering healthcare stocks. And then during the financial crisis, I picked up coverage of the life insurance companies on the equity side. And that was a really interesting time to cover life insurance because, well, as we all remember, the markets were under an immense amount of pressure back then. Bond prices were really low. And these insurance companies have really big portfolios with a lot of leverage. And so the portfolios were roughly 10 times the size of their equity position, which meant that even small losses on their portfolio could result in a really big impact on the company. And so I dug into those portfolios. I set out to learn them inside and out. And my thinking was that if I could figure out which companies would have lower losses than what the market expected, those could be great stocks. And so I relied really heavily on our fixed income team. I got to know our fixed income portfolio managers or traders or analysts as I dug into those portfolios to help me make really good calls. And as is usually the case with the collaboration that happens across equity and fixed income, I think that's one of the big differentiators for us. I think it gives us a big advantage. My insight from the equity perspective also helped my fixed income colleagues make good decisions within the bond portfolios. But as I went through that process, I ended up loving everything about fixed income, the asset class, the analysis that goes into it, the different types of bonds that are in the market. And so in 2012, when there was an opening on the fixed income team, I raised my hand for it, and I was fortunate enough to get it. So at that point, I became an analyst in fixed income, covering all of insurance on a global basis. So life insurance, property and casualty insurance, including both U.S. names, Canadian names, but I also had coverage of the GSEs. So that would include Fannie Mae, Freddie Mac, the home loan banks, which gave me an interesting perspective on that side of the market. And then in 2016, so 9 years ago now, I became a portfolio manager on what we call the core and core plus team.
That's an amazing background, and you caught me early on in your discussion, and I'm sure our viewers, on the fact that you went from equities to fixed income. Often we hear about equity analysts becoming diversified portfolio managers on the equity side, and fixed income analysts sometimes being analysts for a long part of their career, but you made that very progressive. But I love how you bridged your equity expertise with fixed income knowledge and so on, and it's a very nice connection, and I'm sure a real asset to the overall team. Now, the fixed income team is in Merrimack, New Hampshire, about an hour north of Boston, correct?
Right.
And what are the assets go ahead.
Well, it's interesting. So when I first joined Fidelity as an equity analyst, really all I knew about Fidelity was the equity side. You hear all the stories around how the analysts really dig for value. They're out there seeing companies doing this amazing research. I had read all of Peter Lynch's books before joining Fidelity, and so for me, joining Fidelity was a dream. But I came into it just with that equity perspective. I really wanted to be a stock picker. But when I went into that role on the insurance side and I found what we had in fixed income, to me, it just seemed like a bit of a hidden gem when I came across it, just the expertise that's there and all of the resources. But to your point in terms of assets, maybe it's not that hidden. I mean, right now we manage as a fixed income organization over $2 trillion US dollars in fixed income assets. So we are a very large fixed income manager, and then on our team directly on the Core Plus team, Core Plus Tactical, we manage about $260 billion.
When you're in company meetings, when you're involved in discussion around balance sheet, when you're involved in discussion around credit issuance, part of your brain is looking at it as an equity analyst as well. I'm sure you're actually looking at it more thoroughly than if someone was just on this side or this side. A real asset for you and for the team, I'm sure.
I think it does help me in the investment approach, but maybe even taking a step back from that, Glenn, I think one of the big advantages that we have as a fixed income manager is that equity presence. Not many can claim to have that. And can I just give you a couple of quick examples?
Absolutely.
Yeah. Okay. Great. So every single year, we get thousands of meetings with CEOs, CFOs, heads of business units that come in to see us. And at those meetings, we have our equity analyst, but importantly, our fixed income analyst is sitting in the room. Our equity portfolio managers are in the room, but also our fixed income portfolio managers are in the room. And what that means is that we end up having a really balanced discussion. Think about being a CFO in that seat, sitting across the table from both the equity analyst and the fixed income analyst. And that's a situation where, odds are that we may be their largest shareholder. And if we're not their largest creditor, they probably want us to be their largest creditor. But for a CFO, that can be a really uncomfortable spot to be in, because odds are they're going to say something that's going to upset either the equity analyst or the fixed income analyst. It's really hard to make both of them happy. And then once they leave the room, the analysis that they do together ends up adding a tremendous amount of value to both us fixed income portfolio managers and equity portfolio managers at Fidelity.
That's a great story, and so great to hear that you're not working in silos, and I love that bridge. Now, because you're involved in so many portfolios that are available in the United States and also available to us as Canadians, let's maybe, for the sake of this webcast today, focus on two: multi-sector bond and global core plus, because those are very active, very popular in the Canadian marketplace. And in the past, Jeff Moore would be talking to us, perhaps along with Mike Plage. Jeff is retired. You've been on the team for a long time, and that's why we're talking to you. How do you and Mike divide your responsibilities with these two portfolios in particular?
So Mike and I are partners, and we've been sitting next to each other on an open trading floor for the last 9 years, along with the rest of our team. So we've got a team of 5 portfolio managers. Every single day, we are exchanging ideas on what's going on in the macro environment, what's going on in different sectors that we're interested in, what are the new issue opportunities in the market, what are good secondary trade opportunities. And by the way, we have the benefit of not only the 5 of us being on a team, but out on the open trading floor next to us, we've got corporate traders, we've got securitized traders, rates traders, and then analysts, fundamental analysts that sit all around the trading floor. So there's a lot of input that we can get and a lot of really great expertise. But to answer your question, we as portfolio managers on the team are working together to make sure that all the very best ideas are making it into the portfolios, and that the risks that we're taking in the portfolios are the appropriate risks.
So $2 trillion run by the entire fixed income division that's up in Merrimack, and it's open concept. So you're from all different aspects, you're absorbing from one another. So different than those that would be, that are locked in an office perhaps in different environments. But that open concept must be very stimulating for thoughts and ideas, and from all the different areas.
It really is. And it extends to not just portfolio managers and traders, but, and this is one other differentiator between us and our competitors, we've got our quantitative analyst sitting directly next to us. We've got a quantitative analyst that's dedicated to our team specifically, the Core and Core Plus Tactical team, and there are quantitative analysts that are dedicated to all of the other portfolio management teams within fixed income at Fidelity. And the great thing is that we can get direct insight from them on different scenarios that we're looking at within the market, how different moves in the market might impact our portfolios, and what is the general risk position of the portfolios. And they help us run our proprietary risk model where we get a lot of really great insight into the portfolios from that. And that's different from what others are doing, where at some of our competitors, they keep the quantitative analysts really separate. I like to joke that sometimes they keep them out in the basement, hidden out of sight. Well, that's not what we do. For us, they're front and center, really helping us. And by the way, the model is proprietary; it's our own. If I have a question about it, I've got the expert right there, and I can tap into them for expertise. So some of our competitors are relying on a third-party product, and if they have a question about that or have a complaint about how the model is being run, well, they have to basically open a support ticket, calling an 800 line somewhere to try to get help, which is not the case with us.
Final question on the structure, and that has to do with, I was up there years ago, and your whole team does very early in the morning meetings. Is that still the case? The whole floor.
That is still the case. It's one of the things that I love. Every single morning, we start off the day by having a meeting where each of the traders in each of the different functions will give us a rundown of what they saw on the day prior and what they're expecting for the next day and what they're really focused on. And it tends to get kicked off by our London traders, and then we'll hear from our U.S. rates traders and our securitized traders and our corporate traders, and we also get some insight from our muni traders and from our money market traders, which I think also adds a lot of value to our process. Having that insight into what they're seeing at the front end of the market. Often they're a little bit like the canary in the coal mine, where they can give us really great indications of any stresses that they might be seeing in those funding markets.
Can you explain tactical credit?
Yes. So the way that our tactical portfolios work is they've got a little more flexibility than what you would see in a core and a core plus portfolio. So on our team we run a range of strategies that range from portfolios that invest strictly in investment grade credit. But by the way, all of our portfolios are diversified. We tend to be benchmarked against the Bloomberg Aggregate Index, which, as most of you know, that's an index that consists of treasuries, corporates, and securitized, mostly agency mortgages. And so that's the broad universe that we'll look at when we're thinking about the overall risk composition of our portfolios. But when it comes to something like our total bond fund, in that portfolio, we have the ability to go up to 25% and below investment grade. If you're looking at multi-sector bond fund, that's got a little bit more flexibility. And historically, we've targeted somewhere in the range of 30 to 50% in below investment grade. At market extremes, that might vary, and I'm sure we're going to talk a little bit more about the market and our current outlook. Today, we're taking less risk than we have historically, and so today we have about a 20% position in below investment grade securities.
Makes sense. Now let's talk about the market, and let's talk about those meetings that you said you have as a group every morning first thing. Thursday morning, it must have been a long meeting talking about and deciphering what the Fed talked about on Wednesday afternoon. Let us know your thoughts.
Yeah, so fortunately there wasn't a tremendous amount of surprise in terms of the action that the Fed took. So what we saw was that the Fed opted not to cut rates, and that's exactly what the market had priced in, and that's what they delivered, a pause at least for the time being. Now, as you look through the statement and the way that Powell answered the questions during the press conference, you get some pretty good insight into the way that they're thinking about the market. And so the things that stood out to me is that Powell highlighted two things. One, he highlighted that economic expansion, to use his term, is still in solid territory. And if you look at the labor market is still very solid. Now, I think both of those factors are very true. I have seen some softening over the course of the last 18 months or so, and we can talk a little bit more about that. But I think the economy is still in solid footing. But what he followed that up with is that there is a great amount of uncertainty at this point, and a lot of that is related to policies out of the administration and the tariffs that are being proposed. Uncertainty around what shape they actually take, when they get implemented, and what impact they ultimately have on the market. And so that does warrant a little bit of caution. But I thought Powell did a really good job of asserting some calm in the market, and you could see that in the reaction within the market. Both bonds and stocks, I think, reacted fairly well to the announcement and to the press conference. So I think mission accomplished there. I think job one for the Fed is to not induce volatility, and they got that done.
Could you, since we're on that note, could you also give us perhaps a macro view on tariffs, just to clear that up, because that's adding to this uncertainty, isn't it?
Yeah, no doubt about it. I mean, it's a big topic. When we are in meetings with those CEOs and CFOs, it's one of the topics that comes up, and we're trying to identify what the impacts are to the earnings of all of these different companies, and trying to identify which sectors are being impacted. And so, a couple of points on it. One, I think that tariffs have the potential to slow down the economy. They tend to be a drag on growth. And so the initial point, or the broader point, I think, to make for fixed income is that if you think about what happens to yields and how yields have reacted historically to changes in the rate of economic growth, well, there's a pretty strong correlation there. And what we've seen is that slower rates of growth tend to be associated with lower levels of yield. And so to the extent that tariffs come through and impact the overall level of growth, well, we might actually see an environment where yields come down, and that would be a positive with respect to returns for fixed income. So I think that's generally a backdrop that would be beneficial to fixed income. However, it is a tax on growth, and so and it has a disproportionate impact on certain sectors. So I think the broader question is the analysis that happens at the sector level. I think it's a broader equity question, because you're looking at the income statement impact across different sectors. Tariffs have the potential to create winners and losers. And so it's important to identify those. And our analysts have done a lot of work to identify those. But like I said, I think the broader impact is an income statement one, as opposed to a credit quality impact statement impact for the most part.
How do you, as a portfolio manager, and your team take advantage or prepare yourself for the velocity of information that we're seeing, the uncertainty that you've just referenced? How do you have the portfolio so that you can be opportunistic when you see areas that you want to deploy that capital?
So a couple of points, Glenn. One, I think volatility is opportunity. It presents a tremendous amount of opportunity for us, and we've taken advantage of that historically, many times over. Now, when you look at the market today, I think the bond market is actually incredibly attractive, but spreads in general are fairly rich, and I can give you a lot more detail on that. But what that means is that it's prudent to position the portfolios in such a way that the risk position is lower than where it would be otherwise. And that's exactly what we've done in the portfolios. The risk level in the portfolios today is lower than where it's been historically. I mentioned in multi-sector bond fund, historically, we under most market environments, we'll target a 30 to 50% allocation to below investment grade securities. Today, we're at 20, so far below that. And it's a similar story when you look at investment grade corporates. We've got a fairly small allocation, and for the most part, we've avoided long corporates, which are really sensitive to moves and spreads. And so we've isolated the portfolio to the positions where we think we can generate a lot of really nice income. And are protected from a credit spread move perspective. And so right now, the portfolios have a lot of dry powder. Relative to history, we've got, like I said, lower risk, but that also means that we've got a lot more treasuries than we've had historically. And those are nice liquid securities. If we get about a volatility, which undoubtedly at some point we will, that'll give us an opportunity to buy bonds at cheaper levels. Now, I think the economy is generally in good shape right now. So I'm not that concerned about a big deterioration in fundamentals or a big increase in defaults. What I am worried about is that there might be some volatility in spreads. And historically, we've seen this movie before. Think back to 2020, early 2020, the economy actually was on good footing. there was decent growth, unemployment was okay, corporate fundamentals also looked good, but valuations were very rich. And at that point, we also positioned the portfolios to be at the lower bounds of risk, knowing that at some point we would get an opportunity to add back to risk. There would be some bout of volatility. We didn't know what it would be. But we know that the market presents it. That March, we got an immense bout of volatility in the form of the pandemic. And that created a really big buying opportunity. We took advantage of that. At some point, I do expect we'll get another bout of volatility. I don't know what it'll be. I hope it's not another global pandemic. But I'll tell you, when we do get it, we'll be ready for it. Just like we were ready when Russia invaded Ukraine, or when the regional banks went through their crisis back in the spring 24. These events happen over and over, and the key is to be ready for it and to have the analysis done on all of the various sectors and have the resources to be able to identify where there's value.
I agree with you. Let's not go down the pandemic road again. But as you've talked about, you've reduced risk in your portfolios. You've also got liquidity should you need it, because as you mentioned, uncertainty breeds opportunity. Your portfolio, looking at multi-sector bond or global core, you aren't restricted to the United States. How are you managing risk by looking at global opportunities?
Yeah, great question, Glenn. Yeah, so you're right. We're not restricted to it. We've got a lot of flexibility in the portfolio, and I think that's something that adds a lot of value, especially considering that we've got all the right analysts and the right traders to really help us identify value across these different areas. And so we've got an allocation to global credit, and that's been a really nice performing sector for us. This is where we'll go out and we'll invest, primarily in investment grade European credit, both on the industrial side and on the financial side, and for some time now, we've actually have seen those corporates trade at wider spreads than U.S. corporates. There was better value there, and that, by the way, is a reversal from the long-term history. The long-term history is that European credit actually traded through U.S. credit, so it traded at tighter levels, richer levels, and so we were taking advantage of that difference that did not exist historically. And just over the course of the past couple of months, we've actually have seen those two spread levels converge. So now they're actually trading at very similar levels. So that was a nice benefit to the portfolios to have that exposure. Similarly, when it comes to emerging markets, we've got a great crew of analysts, and we can dig in and find really interesting credits that add a lot of value, and that are mispriced. And so over time, we've bought some names in Mexico, for example, or it could be corporates, it could be government agencies, and also some sovereigns that I think that are attractive.
So you've talked about global diversification, and you've talked about a lot of very traditional sounding asset classes, but Fidelity, your team are able to go into less traditional asset classes as well, asset-backed securities, commercial mortgage-backed securities, and so on. Could you talk about them?
Happy to. So the securitized market, and if you think about what's in the benchmark, and what a lot of our competitors have really focused in, for the most part, it's agency mortgages. And agency mortgages right now, in my opinion, are trading at very rich levels. There's not a lot of value there, and so in some portfolios we don't own them at all, and in some other portfolios you have a very big underweight to them. So they're not attractive. One, given that spreads are really narrow there, and also think about what's going on with Fannie Mac and with Fannie and Freddie. So right now, there's a lot of talk about Fannie and Freddie exiting conservatorship. Well, most of the scenarios that I think about when I think about them exiting conservatorship would have a negative impact on spreads, and so I think that's another obstacle to overcome. There are ways to structure an exit out of conservatorship that doesn't have that negative an impact on spreads, but most of the scenarios I think would be negative. So we've opted to really focus elsewhere, and the benefit we have in focusing in other areas is that these are areas where our analysts can really dig in and do a lot of great work. So I'll give you a few examples. within asset-backed securities, there are deals that have come to market that are backed by the franchise fees associated with some of the large restaurant chains in the U.S. and abroad. So, for example, sandwich shops or donut shops or pizza shops. These large chains that many of our listeners here are, I'm sure, are familiar with. Well, with those, our analysts can go in, do the work on the fundamentals, identify how strong those businesses are, what the growth prospects are for them, and we can do a lot of work to figure out exactly where in those structures we want to be. We've also invested in bonds that are backed by leases on aircraft out to big airlines, and that's one example I love because our securitized analysts will work really closely with our aerospace and defense analysts, so the analyst that covers Boeing and the other aircraft manufacturers, for example, to figure out what kind of planes are in that structure. Are they narrow bodies? Are they wide bodies? Are there newer planes or are they older planes? And which one? And where is the demand? Which ones are the safest ones for us to invest in? And that's the approach that we'll take. On the CMBS side, the commercial mortgage side, when deals come to market, our team is a really strong team on the property side. They already tend to be familiar with the properties. They know the tenants that are in those in those properties. They know the lease structures. They know how to stress test them to really severe levels to make sure that we can be comfortable with those holdings through a market and a credit cycle.
A couple of words you mentioned: structure and tenants. You must have a number of lawyers that are also involved in the research of these issues.
So as part of the team, we make sure that we go through all of the documentation, and our analysts have full availability of our legal team to review those both at the outset when we're initially investing in these, and for some of these deals when they come to market, we're a large participant. A lot of these issuers that come to market want us in their deals, and so we'll often get an early look at them, which means that we do the analysis early, and often we actually have a say in shaping the actual documentation. So, for example, a few years ago when we were going through that LIBOR to SOFR transition that so much of the market was worried about, well, in a lot of the deals that we had invested in, we actually had already assured ourselves that there was good backup language there, good transition language, because we actually had a hand in shaping that documentation. So that's at the outset of the deal, and then down the road, whether it's a structured deal or whether it's a corporate deal or a high yield deal, if there are any inklings of trouble in any of those, we do have a legal team and a special situations team that can really dig into the details there and help us extract a lot of value from those.
That's amazing. You've talked a lot about the abilities to go to different asset classes, the abilities to go globally. That's a luxury, I'm sure, in this type of environment that we're in. Could you conclude this webcast today talking to us about the benefits of an active portfolio in fixed income versus a passive portfolio in this environment?
There's no question that active management in fixed income helps a tremendous amount. If you look at if you do the analysis and you can do a comparison of actively managed fixed income portfolios compared to passively managed income portfolios, you'll see that it's night and day. The active managers have a strong record of outperforming the passive competitor. And I'll give you one example of what ends up driving that difference. So a lot of these portfolios are benchmarked against the Bloomberg Aggregate Index. And when you look at that index represents or tracks roughly $28 trillion worth of bonds. That's a big number. It sounds really impressive, but it sounds impressive really only until you consider the fact that if you take the entire U.S. bond market, the U.S. bond market's actually much bigger than that. It's probably $55 trillion or even bigger than that. And so there's this whole world of opportunity that the index and the passive players avoid. But at Fidelity, we have a really broad research team that has the ability to dig into all of these other asset classes and find value for us. So that's just one example. There are a number of other reasons why active management really works within fixed income.
That was a strong example. And Celso, I'm going to have to just at this point end our webcast. And thank you so much for being here. And it was wonderful to talk to you on your first webcast with us as well. Thank you.
Well, Glenn, thank you for having me. This was a lot of fun.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.